The Reserve Bank of Australia raised the cash rate to 4.35% on Tuesday, its third consecutive hike since February, and the decision had very little to do with domestic demand. It had almost everything to do with what happened overnight in the Persian Gulf. U.S. and Iranian forces exchanged drones and missiles near the Strait of Hormuz for the second time in weeks. The UAE's energy hub at Fujairah was struck. Brent crude surged more than 5% in a single session, reaching US $114 per barrel, the highest price since Russia invaded Ukraine in 2022. That number landed on Australian desks before markets opened, and it changed the calculus entirely. The RBA's own statement made the mechanism explicit. The central bank said the Middle East conflict had produced sharply higher fuel and commodity prices, already feeding into inflation. Headline CPI had already risen to 4.6% in the 12 months to March. The trimmed mean, the RBA's preferred internal gauge, remained above its 2 to 3% target at 3.3%. 8 of 9 board members voted to hike. The one dissent was for a hold, not a cut. What makes this hike structurally different from the February and March moves is the second-round signal. The RBA is not just responding to the oil price itself, it is responding to evidence that firms under cost pressure are beginning to pass those costs through. Short-term inflation expectations have risen. The central bank is now fighting a transmission problem, not just a supply shock. Governor Michelle Bullock was explicit at the post-decision press conference. Inflation was already too high before the conflict began. The war made the trade-off materially worse. Without it, there may not have been a third hike. That same oil shock, working through fuel costs, freight margins, and household budgets, is now showing up directly in equity prices, and the damage is concentrated in exactly the sectors most exposed to the squeeze: consumer discretionary, healthcare, and retail. CSL shares hit a 9-year low of $122.48 on Tuesday, down more than 50% over 12 months. Wesfarmers fell to a 52-week low of $71.31, off 9% year-on-year. Temple & Webster, a bellwether for discretionary online spending, dropped to a 2.5-year low, having lost 69% of its value in the past year. Accent Group reached a 13-year low. Adairs fell 51% over 12 months. The pattern is consistent. Anything dependent on Australian household spending is being repriced lower. The mechanism is not subtle. Consumer sentiment recorded its largest single-month decline since the start of the pandemic in 2020. Households are managing a combination of mortgage repayments recalibrating to 4.35%, fuel costs elevated by a war they cannot control, and grocery inflation that preceded the conflict. The three pressures are not independent. They compound. The RBA's baseline forecast assumes the Iran conflict resolves soon and oil prices fall back. But eToro's Josh Gilbert, commenting after the decision, noted that the Strait of Hormuz remains effectively closed. As long as it stays that way, the upside risk to inflation does not clear. Markets are already pricing another hike before year-end. The sectors holding up are energy, up 0.89% on the day, and technology, where AI infrastructure spending is insulated from the fuel shock. NextDC locked in $1.8 billion in new debt funding on Tuesday, taking its total available liquidity to $8.2 billion. The divergence is now visible in the composition of the ASX 200's daily movers: energy and tech up, financials and materials down. That split will not resolve until either oil falls or the RBA signals it is done. While the rate hike pressured most of the ASX 200, one sector moved in a different direction. The gold space produced the day's largest deal announcement, and the structure of it reveals how miners are betting on the current macro environment. Regis Resources and Vault Minerals announced a $10.7 billion merger to create Australia's third-largest ASX-listed gold producer. The combined group will produce around 700,000 ounces per year, positioning behind Northern Star and Evolution Mining on the ASX Gold podium. Regis will hold 51%. Volt shareholders take 49%. The deal is expected to close in August or September, with a $50.7 million break fee on either side. Gold is at US $4,536, roughly $1,000 below January's peak, but still at historically elevated levels. The merger is not being done at the top of the gold price. It is being done at a moment when the cost of production is rising: fuel, labor, equipment. and when smaller standalone operators face genuine margin compression if oil stays elevated. The logic of the deal is not just scale, it is resilience. The combined entity will hold nearly $2 billion in cash. That balance sheet gives the merged group optionality that neither company had independently, the ability to pursue further consolidation. Argonaut analyst Hayden Bairstow flagged Tropicana, one of Australia's largest gold mines, where Regis already holds 30%, as a likely next target. Genesis Minerals had also been a rumored fit for Vault, given operational proximity. The deal continues a wave of ASX gold consolidation. Northern Star acquired De Grey last year. Ramelius merged with Spartan. Goldfields absorbed Gold Road Resources. The pattern is repeating because the macro conditions reward it. Gold benefits from geopolitical uncertainty, but higher rates create a ceiling on the price. Miners who cannot grow the price can instead grow the ounces through deals. The verification threshold here is the oil price. If Brent stays above US $110, the inflation pressure on rate-sensitive equity persists, and gold's relative appeal as a hard asset hedge remains structurally supported. If Hormuz reopens and oil falls back below US $95, the inflation narrative softens, the RBA may pause, and the rate premium that has been suppressing gold's price ceiling partially lifts. Either outcome is possible. What the Regis Vault merger signals is that management teams are not waiting for resolution, they are building for an extended period of uncertainty. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.